Yeah, I think what we've seen this year is a bit of a return to normality in the markets. There have been some big moves in recent years, and this year things have stabilised a little bit. Profitability is good among the large companies. The economy is in good shape, and the market has stabilised somewhat, which is nice after a few pretty volatile years. Probably the main trend I would call out is a big recovery in growth stocks. So the technology index is up by 20% this year, and we've seen that move repeated overseas as well. The difference is that this year the market is a bit more discerning when it comes to growth stocks. So the way I would think about it is a few years ago the market only wanted to see growth and they didn't care about profits. And then last year growth was really on the nose and it sold off a long way, somewhat indiscriminately. And this year the market is much more discerning. So businesses that can grow and generate profit are very much back in favour, and they've rallied strongly, while some of the former growth market darlings have really flamed out. That more discerning market is a better environment for investors like us because we tend to focus on the ability of a business to generate a sustainable profit, not just drive growth in user metrics. I think the obvious risk is that the economy could get weaker from here. So obviously the economy today is about as good as it gets. Unemployment is at a historical low. Households are spending money, corporate profits are high, house prices are rising again, things are good. So clearly the risk is that it gets harder from here, and I think that risk is well understood. At the same time, you could see demand falling away as pressure increases on the household, at the same time as cost pressures are coming through. So you could have a real crunch time for margins in certain sectors. So this risk is well understood. The key point though is that not all businesses are going to respond the same to a difficult environment. And in fact, over the last 12 months, we've seen cost pressures come through. And if you take the example of Brambles, this is a company where their input costs went up a lot last year, and demand for their product also fell at the same time. But profits increased and the share price has done really well. So how is this possible? Well, they've got a competitive advantage. Their customers need their product and they have few other options, so Brambles is able to push through price increases. And that's what makes them a resilient business. And I think businesses with those characteristics are going to continue to do well, even as the economy weakens. More generally, one of the risks that we see for investors is a series of challenges to strategies that have worked well in the past. So growth-focused investors have had a tailwind of 20 years of interest rates falling and asset prices rising. And that has been helpful for their returns over a long period of time. And with interest rates at a more normal level, I think that trend has run its course and life probably becomes harder for that style of investing. Meanwhile, value investors are looking for companies, which maybe are a little bit down on their luck. These are the companies that are going to struggle the most in a more difficult operating environment with weaker demand and rising costs. So I think both growth and value styles maybe face some challenges. I think the right approach in the market as it is today is a more selective approach. In fact, I've never seen a better environment for active managers than what I see now. You really have to be selective and look for businesses that have characteristics that make them resilient to a more difficult environment. Yeah, we see opportunities across the market, even if we do see a more difficult economic environment. I think the best opportunities are probably in the more resilient businesses for obvious reasons. But you also see good opportunities in businesses where the market thinks they're not going to be resilient, but we think they're actually better placed. A good example there would be Qantas, where the market is very sceptical of the ability of that business to maintain its current level of profits. Demand for aviation is cyclical, and that is an industry which historically has struggled when it faces overcapacity. But we think the competitive environment there has changed quite significantly, and we think it's very unlikely that you'll see overcapacity in aviation in the near term or in the foreseeable future. There basically aren't enough planes to carry the number of people who want to fly at the moment, and that's giving Qantas an enormous amount of pricing power. At the same time, their main competitor, Virgin, is seeking to boost its own profitability, so the conditions for a price war are simply not in place. So that's an example of a company where the market is sceptical of it, but we think it will prove to be surprisingly resilient. Another area where we see good opportunities is where the market is focused very much on what we think is a short-term issue, and that creates weakness in the share price of a company that has excellent long-term prospects. And so a good example there is Fisher & Paykel Healthcare, which is a business that we like a lot. It's likely to grow at double-digit rates for a decade or more. Today, the market is very focused on near-term profits because they've seen a rise in some of their input costs and there's a delay before they can pass those on. And so the share price has been weak, and we think that creates a good opportunity for patient investors to get set in a high-quality business. Well, our approach is simple. We look for good businesses in a range of different industries. We like businesses that can grow regardless of what happens in the economy. And most of all, we like businesses that can beat their competitors. So we seek some sort of competitive advantage. Some of the companies we own are actually monopolies. We like Transurban and we like the ASX. Some of the businesses in the portfolio are simply the leading player in their industry, and they have some edge over the competitors. That means when times get tough, or if times get tough, customers will continue to do business with them, and if need be, they can put their prices up. And Brambles is a good example of that. We don't know where interest rates are going in the next 6 months or what's going to happen to the economy, but we think if you can build a portfolio of resilient businesses which have an ability to grow, and if you can find businesses like that that are in a range of different industries, then you're going to do well over time.